Hello everyone, Peter and Driana here from Continuum 2, and I'm going to talk to you today about understanding your life insurance options. We're going to compare 10-year term insurance with Universal Life, a minimum funded contract, and a permanent 20-pay policy. We're going to look at a 40-year-old male, non-smoker, $500,000 in coverage. Something to understand is that this comparison will work pretty much the same for any age, as well as male or female, and pretty much any coverage amount. So the first thing people typically ask is, what's the cost? How much are my premiums going to be? And we can see here, without a doubt, the term insurance is going to be the least expensive in the short term. The next thing that we would encourage you to consider is, what's the equity? What's the cash value? Is anything building up? Is there any investment component in this coverage? So term insurance, there's never going to be any investment value other than the death benefit. And the way I describe that is, consider when you rent and you're renting a house or an apartment. After you rent for 10 years, the landlord's never going to come back and give you any money back. Whereas our permanent 20-pay policy is much more like owning a home. It's going to increase in value over time. So the estimated value for that permanent policy after 10 years is almost $47,000. The death benefit after 10 years, the term insurance and Universal Life is going to stay at that $500,000 mark, where our permanent policy is going to have grown a little bit up to $551,000. If we keep moving and we look at what is our health going to be in 10 years, with our term insurance, we don't know, and it actually is important. With the Universal Life and the 20-pay policy, we actually don't care because the coverage is going to be guaranteed for life as long as you're paying those premiums. When we look at the term insurance and why it's important what our health is because if we're not healthy at age 60, our premiums are going to be skyrocketing. They're going to increase significantly, and you can see that in the numbers here. If we are healthy, we can write a new policy and get new coverage, but as we can see, it's significantly more than what we were paying when we started that contract. The Universal Life and the permanent policy, on the other hand, have a different scenario. So the Universal Life will always be that same $4,301 per year. Our 20-pay policy, it's called 20-pay because you only pay for 20 years. So at age 60, it's now fully paid up, and there's no more premiums payable, guaranteed, and written into the contract. Our death benefit at age 60, well, the 10-year term and the Universal Life are always going to be that $500,000. If we look at our 20-pay policy, it's now grown to $824,000. So you can see there's been some significant growth, almost $325,000 more than when we started. If we keep pushing here and we look at what's the total cost that we've paid in premiums at age 85, in the not healthy scenario for the term insurance, the total premiums would have been actually more than the death benefit, $517,000. The Universal Life is $193,000, and our 20-pay policy would have been $270,000. So if we stopped our analysis here, it seems pretty simple. Oh, I would pick the Universal Life. It's cost me the least amount. But if we keep pushing and saying, well, what's the equity? What's the cash value? How much have I earned inside of this policy at age 85? So the term insurance, like renting that apartment, is going to be zero. The Universal Life, zero as well. It's a minimum funded contract. Now, our 20-pay policy is now worth $1.5 million estimated at the age of 85. So now we start to get a much different picture. We might have some different considerations when we think of, well, why am I doing this coverage? What am I thinking when I'm talking about the premiums that I'm paying? And what am I looking for? Is it long-term coverage, 20-pay, or is it short-term like I want to cover a mortgage? Or maybe it's a combination of the two. If we're talking about long-term coverage and we're looking at age 85, that term insurance policy is going to end at age 85. So when you think about it, that's not long-term coverage. It's going to end, and there's going to be no death benefit after age 85. The Universal Life, it will stay, but it'll be $500,000. It'll always be that $500,000 amount. Now, if we look at our 20-pay policy, we're at $1.8 million now. So $1.8 million estimated at age 85 is a significant increase over what we started with, which was the $500,000 in coverage. So insurable at age 85 becomes important because if someone's had that term insurance the whole time and then realizes I want some coverage after I'm age 85, it's not available any longer. So we're kind of stuck without coverage. Now with the Universal Life, we're still insured and we're still paying those premiums. So that's an important thing to understand, is that in the start, it might seem, well, I'm saving some significant money because I'm only paying $4,300 versus $13,000. But when you then consider you've got to pay the entire life of that universal life contract and there's no equity or cash value, this 20-pay policy seems to start to make a lot of sense. We're still insured, we've paid no premiums for 25 years, and we've got an estimated equity or value inside of that policy at $1.5 million. Something also to understand is that $1.5 million grows tax sheltered and creditor protected if the policy is set up correctly. So some really important considerations. So if price was not an issue, which policy would you prefer and why? And if price was not an issue, which policy would you not want and why? And I think it becomes pretty clear that they each have their spot and they each have their need, but you might have more to consider than you initially thought than just the premiums of when we started. Thanks so much. I appreciate your time, and feel free to reach out with any questions or comments.